Welcome back to the Open Web Forum. Looking forward to kicking things off for a great afternoon of speakers to round off what has been a stellar Open Web Forum so far. A reminder of what we have lined up for this afternoon. In a few minutes, we will be exploring venture investing in the open economy. And following up, we'll be exploring beyond the horizon with a post-quantum world. What will crypto's role be then? Our penultimate session of the Open Web Forum will deep dive into gaming and new avenues of monetization, which are rewarding participants for their efforts. Given how exciting our earlier NFT panel was, this is one to watch. To round off the forum, we'll have a fireside chat between Vitalik Buterin, inventor of Ethereum, Richard Waters, West Coast editor of the Financial Times, and Tom Bolton-Pocock, head of research at Fabric Ventures. This will be emceed by Richard Muirhead, managing partner of Fabric. I can't think of a better way to end this Open Web Forum. But for now, let's get started with venture investing in the open economy, moderated by Thibauld Favre. As the CEO of Fairmint, Thibauld is dedicating his time to reinventing the financial incentives underpinning today's organizations. Fairmint is dedicated to transitioning the world towards stakeholder capitalism by giving founders the ability to easily turn their stakeholders into investors directly from their app or website. Thibauld, over to you.
Hi, everyone. I'm thrilled to be here to be your host today for this panel about venture investing in the open economy. Before we begin, I'd like to ask you all to see where the Q&A section is on your screen so that you may ask any questions at any time while the panel is ongoing, and I'll try to catch them and ask them to our wonderful speakers. So talking about speakers, so today I'm very pleased to be moderating this panel with Richard Muirhead, managing partner at Fabric Ventures, Aram Verdiyan, partner at Accolade Partners, Shen, partner at Electric Capital, and René, investment manager at the European Investment Fund. Hi, everyone. Why don't we start with a very brief 20-second introduction so that everybody can see who you are and what you're doing. Hi, everyone. I guess you heard what I was saying. So maybe let's start with you, Richard. Can you introduce yourself in a few seconds?
Absolutely. Thanks so much, Thibauld. You guys can hear me? Great. So yes, I'm managing partner of Fabric Ventures, and we, as we like to say, we think what is somewhat unique about this new phase of software and software investing is that there's not just new businesses, but there's whole new business models. And I think actually we're, in some senses, seeking to upgrade capitalism itself, which is, I think, a pretty big thing. And so super excited trying to help founders with the whole kind of ownership or bust approach to building out new businesses, and as they kind of spark a whole new wave of ventures and opportunities.
Thank you, Richard. Maria, you want to take it?
Sure. Hi, everyone. Glad to be here. My name is Maria. I'm a partner at an investor at a firm called Electric Capital. Electric Capital is an early stage venture capital firm that focuses on crypto and blockchain projects based in San Francisco. Just briefly on my background, before joining Electric, I was co-founder and CTO of a supply chain startup. Prior to that, I was at Microsoft for a couple of years as a PM there, working on search tech. I graduated from Harvard with a degree in political science and computer science, and have a master's in computer science as well.
Thank you, Maria. René, take it away.
Hi, everybody. René here, joining from Germany. I'm an investment principal at European Investment Fund. We are a fund of funds, so we are backing people like venture teams, essentially, across all sorts of strategies. We're probably the biggest institutional investor in Europe, and we pretty much back all sorts of strategies, including strategies in blockchain and crypto for a few years. Crypto, we have been active for the last three and a half years, doing commitments in venture funds that particularly focus on building interesting projects there. And my personal background, so I'm French first name, Spanish surname, but I'm German. I have a PhD in data science and a master in corporate finance, and I work for EF since the last 4 years nearly.
Thank you, René. And finally, Aram.
Thanks everyone for having me today. I'm Aram, partner at Accolade. We are a fund of funds based in Washington, D.C. Firm is about 21 years old. We manage about $3 billion in assets, investing across early stage venture, growth equity, and blockchain. We have a dedicated blockchain fund of funds that focuses on investing in blockchain funds that take an early stage long-term approach. By the end of the summer, we should have about 400 million raised under the strategy, and we're one of the largest allocators in the space.
Thank you very much. So let's dive right in. And so I guess the first question, I will ask something like about investing in the open economy. So if you're into crypto, you probably realize that it seems that investing in the open economy is making SaaS investing look boring, right? Because there's a new playbook, it seems. Right now, we see a lot of new projects coming on and a massive funding coming to big projects. And what are those projects doing is basically they have a very large and engaged community. And then what they do is they create what is called in the industry a governance token, right? That's the team themselves say is valueless to not have any problem with securities laws. And it seems that the right spot for a VC right now is to find these largely engaged communities, invest in the company underpinning those communities, wait to have this company launch a governance token, and then profit. And that yields massive return at a much faster pace than any other type of investment. How close to the truth am I? Maya, you want to answer that question?
Yeah, sure. Spicy question. I like it. So I think the really exciting thing about crypto is that we're learning in real time how these systems work. And these systems are literally evolving in real time, kind of changing day by day. And so the value of a governance token, I think, is something that's being discovered as well. Right now, governance tokens are people who hold governance tokens are the controllers of treasuries that hold sometimes hundreds of millions of dollars. There's an option sometimes, depending on the protocol, to vote in a fee that would distribute back to token holders. And that's again, a governance decision that people who hold the governance tokens have. So I think the question is, how valuable is the ability to make that decision? And then what other roles can you play while holding the governance token? So I think a lot of really interesting questions there, but I think the question comes from the fact that we're not in a bear market. And so it feels like anything is profiting right now. But obviously I know you've been through a bear market where prices are depressed, down 80, 90%. And when that happens, it no longer feels like, launch a governance token and profit. So I think the real returns at the end of the day will come back to long-term holders. And this is something that I believe very strongly in crypto. Along the way, you'll see a lot of peaks. I think a great example is that a lot of sort of OG Bitcoiners don't hold a lot of Bitcoin because from a personal standpoint, it sometimes makes sense to sell them. And it's a rational decision to sell at some of these peaks. But I think a VC has a different mandate where the holding term is long-term. We have, a long-term view at the industry and something that we believe in 7 and 10 year time frame. And so I think, in the long term, we'll see kind of how these governance tokens will play out and where the value accrues.
So what do you think, Richard? Because about these governance tokens, to me, I may look a bit younger than my age, but I was here in 2000, and so to me governance tokens, we don't care about value accrual. That's reminiscent a little bit of we don't care about revenues. That was in the 2000 bubble. So what's your take on this?
Sure. First of all, Maria's covered, I think, a whole host of the key points there. And clearly, one of the distinctions here is that, venture has to think in the long term through the kind of peaks and troughs and think about how the maximum multiple can be delivered to their LPs over that longer term. And I think, you have to distinguish a few things here. Taking your point first, Thibauld, I think, the value in a governance token might be exactly as Maria says, that it's the if there is real governance that can be influence the direction of the technology, but even the commercialization of whatever network is being built, and that will introduce fees, then that indeed is going to be the value of holding those governance tokens when the fees are voted in. I think the jury's out exactly how substantial the value of the governance itself is, but we're certainly a believer, amongst my team or our team here at Fabric, that it's about understanding the different characteristics that a token can possess and combining them into something that will ultimately deliver value. As for the question of this dance around will there be value accruing to the token or not, and it doesn't matter, let's think about revenues or value accrual later. I mean, so first of all, that may be a dance from a regulatory perspective that's taking place, and we all know that there's a lot of catch-up taking place. Secondly, I think that one of the key roles, obviously, of venture is to get sufficiently close to these projects, be it in a bull market currently when the tide is lifting all boats, or in a bear market, and be able to distinguish between those. And I wouldn't want to call out specific projects, but we've got some fantastic forthcoming investments coming through where we thought that they're on the positive side of that, but we've also said no to a whole raft of investments where superficially it looks good, but if you really do your analysis, it is not.
René, maybe because you touch a very good point, you say it's a dance with regulation sometimes, right? This is why they say it's valueless. This is why and so René, you're an LP. So obviously when you want to allocate your money, is it something that how do you approach this? How risky is investing in crypto from an LP perspective? Because I guess you want none of that risk, right?
Yeah, sure. No, as an institutional investor from the fund, of course, that's something we want to shield away, that essentially we as an LP get I don't know, certain tax burdens or regulatory burdens because our funds that we invest in are investing in cryptographic assets. But I think coming back to the point that you initially made, I think add a bit another flavor to that is, yes, with cryptographic assets, there's a lot of interesting upside, and that's what we mostly see. Venture in general is a you could say a risky asset class because the individual projects have a high likelihood of failure, but that's not the purpose of venture. It's looking for the interesting and great opportunities, and they can be in cryptographic assets and governance protocols, but they can also be in classical equity investments in the crypto space, like you actually see with probably Dapper Labs or Soraya or some others, which at the end of the day are using blockchain technology, or in this case NFTs, to build an interesting business model around that. So that's also what, of course, we look into when we look into venture teams, that they're not they're open-minded and see where there are interesting opportunities. Yes, they can be in cryptographic assets, but they can also be in classical venture instruments. And as you say, the regulatory part is a bit of a difficulty, but it's mostly on the GP side. And that introduces a certain, of course, risk element, because if entrepreneurs, particularly in Europe, don't know what's the regulation going to be, and that's what you currently see with a lot of the protocols issuing tokens. They are placed everywhere across the globe, typically in offshore jurisdictions, just to make it work, because there's locally no certainty around regulation. So we hope that at some point in time that eases a bit, and that makes things more clear to a lot of the investors. But essentially, coming back to your initial point, we're looking from both sides. There's value in cryptographic assets and governance protocols and all sorts of tokens, but there's also value in classical equity investment that venture funds are doing.
Aram, do you want to add something to the discussion?
Yeah, on the regulatory front, it's interesting, and I can speak mostly to US regulation. The SEC is spending a lot of time trying to classify what's a security, what's not a security, and I think this really relates to tokens that have cash flows associated with them. And if you think about projects like Bitcoin and Ethereum, they have deemed those not to be securities. They use the Howey test, which says that if there's an expectation of profit from a centralized group of people, then it's a security. In a similar fashion, they deemed the Telegrams and the Kicks to be securities. Now, if you think about those governance tokens, let's take DeFi, for example, where you have cash flows, revenues associated with the transactions. Theoretically, the token holders are entitled to those cash flows. Now, those cash flows are now sitting in the treasury of these companies, and they haven't been distributed as dividends. So that could potentially trigger a security if that happens. Now, there's a lot of really elegant solutions that are being suggested. Very recently, the range token, which is a way for DAOs to manage their treasury, as it's sort of like you're issuing a convertible debt, which is the primary way that DeFi projects can access funding by having all the native tokens sitting in their treasury. The SEC has also introduced the safe harbor token proposal, which says that if a blockchain company in the first 3 years of its operation can prove that it's sufficiently decentralized, it does not have to register as a security. And usually in the life cycle of these token companies, they raise 1 or 2 rounds privately. Within 3 years, they're launching their product, they're launching their token. If the cap table is sufficiently decentralized, if they can prove that the cash flows and the direction of those cash flows are not driven by the centralized management of the team, you can see a path potentially for these not to be securities. Still a gray area, still being developed, but I think the 2 issues the regulators are grappling with is how decentralized are these companies, and how to actually think about the actual cash flows that are being associated with the tokens.
Yeah, so you're touching on a very interesting point, and I want to bounce on this, because like regulation in crypto is kind of like is nowhere and it's everywhere, right? Because crypto enables so many new user experiences that are very new, very innovative, very fluid. But the problem is that we're dealing with value transfer, we're dealing with money, we're dealing with investment, and all those things are like very heavily regulated. And so how it and we love the SEC, obviously we love the FCA, but like sometimes like they're all the rule set is for a world where crypto was not here. So as an investor, how do you approach this? How do you approach like teams that wants to do things, but it might not be very compliant at the time? And so like, do you bet on a future compliance change from the regulator? Like, do you say no? Like, how do you draw the line? Who wants to take that one? Like maybe Richard?
Yeah, I mean, I'm happy to pile in. I mean, we've been, I wouldn't say cautious, prudent, but we take the view that, anti-money laundering, for example, and KYC, these are all, very critical parts of the regulatory system and apply to our business, and should also apply to the investments that we're making. And I do think, however, the problem is in the short term, as you said, the kind of language even that's being used to describe these concepts and these systems and how they're operating, it can be somewhat orthogonal. And so there's going to have to be a kind of rethinking of how that is going to be applied. And people I think are increasingly busy doing that. In the medium to long term, I personally am optimistic that after that short-term pain, that actually, the transparency, the richness of the data, the way things can be automated, will actually mean that from a tax perspective, from a broader compliance perspective, that these new decentralized networks are very much the government's friend, and that or maybe even an upgraded version of the government's friend. We don't necessarily want overly centralized government either, and so I think. So I'm actually very excited about how that can play out, from everything as mundane as bookkeeping and accounting all the way through to your tax, and then ultimately making sure that the wrong actors are not moving funds from one place to another. Is that going to be a pretty thorny area from the perspective of civil liberties and so forth? Yes. Is it poorly understood at the moment? I think there's stuff going through the UK Parliament at the moment. Might be Tugendhat who's involved in this, where I don't think they fully appreciate the fact that this actually gives them much greater visibility than they had before. And so they should be going with the flow rather than fighting it.
Okay. Maria, I will hand it over to you, because you are in Silicon Valley, and Silicon Valley has lots of investors that are known for pushing the boundaries. Like we're thinking about like Uber, for example, right? Like it's like, oh, labor laws, yes, but we'll throw enough money at it that will make sure that change happen. And so what's your take on this?
Yeah, I think part of it is also engaging with the regulators. A lot of fintech companies that we take really for granted today, like PayPal, started off in an area that was maybe in a regulatorily gray area. And a lot of effort was put into engaging with regulators, making sure they fully understood what was happening in the company. And regulations are, at the end of the day, they live to serve the people. And I think as technology gets updated, regulators are also looking at new technology coming in and trying to see if old regulations apply. So I think it's a dialogue on both sides. And I think certainly educating regulators and making sure we're actively having that discussion with them is a huge part of that. And so when we do look at teams, we look at teams who are willing to engage with regulators, are willing to stay on the right side of regulations, and make sure that they're keeping regulators abreast with everything that they're doing.
Okay, so let's go back to like your role, right, as VCs and LPs investing in VCs. So now, like, one of the characteristics of the open economy is that given the right incentives in place, like projects as like many stakeholders like pushing to make the project a success with like many different expertise. And so, Richard, I will start with you, and then I'll ask everybody else. But like, what makes you relevant? What makes a VC relevant? Like, why is it relevant as a VC to participate in networks? And like, do you think you have like a real advantage over like other stakeholders? Like, how do you sell yourself to founders today to say like you can provide value?
Yeah, very good question. So, look, I think our perspective is that we have a strategy which is around the very earliest stage, and I guess whilst I think some of the potency of this whole movement is around the ability to mobilize those communities, whether it be people running nodes or protocol politicians and governance or whatever the activity is, but in the very earliest stage, of course, like most likely nobody has yet heard of the project and you haven't got things up and running. And so our role is, we see as coming in perhaps way before there being any tokens designed, let alone being liquid, being involved in from an equity perspective, most likely in a conventional company, and trying to be involved in the work that's going around in terms of securing the core talent for the team, the core partnerships, working on the token design, signaling, hopefully through our association with the project, that this is one that can has passed the test where this isn't just superficially good and might actually be an interesting investment for a short period of time, but from our lens of thinking about being 5, 10, 15 year holders is, and having an integrity around that really is a very fundamental project. That I think all of those things together can be very valuable to a project in the very earliest days. And then we can roll up our sleeves and do work on those different fronts, including the governance, including running nodes, et cetera, and then deliver value. And happy to take lockups to show that we're tied to the long-term future of the project in the same way as the founders, for example, because that's the business that we're in. Okay, so and now let's ask me like the other question, but like this time for LP. I look at you, René. So obviously you're an LP, so you allocate the money to VCs, and you're happy to compensate them like with like what usually is like 2% management fees and 20% carried interest. But like in the open economy, like everything is much more open. So the things that made VCs valuable before, like exclusive deal flow access, governance rights, all these things like are changing right now. And so what are you looking now? Like when you invest in allocate money to VCs, what justify their value to your eyes?
No, sure. I mean, there is, I would say, on the one hand side, when you look at teams that focus on cryptographic projects and blockchain in general, I would say there are similarities to what we would call probably generalist VCs, or the VCs across the board in terms of qualities they would need to have. Because still from an LP, and you have put the question in an email conversation we had before, that why can we not invest directly? It's probably just the sheer amount of opportunities and having the capabilities to understand them and to find hopefully the good ones. And when it comes to crypto, particularly next to, I would say, general characteristics around the team DNA, the strategy, your fundraising traction, what you have done previously, and all sorts of other, I would say, checks and strategies we look in. For crypto particularly, I think there are two things that we look into. One is you need to have a strong bound to that ecosystem, because it's very different to what we would probably call a generalist ecosystem when you want to create a marketplace for real estate, when you want to create an online shop, when you want to create a B2B SaaS platform for whatever. That's very distinct. You see that in the syndicates that are investing. And so you need to have a strong link to this ecosystem. And B, you need to have people in your team as a VC that have actually an understanding of cryptographic technology, and prove that to us in different ways. And I think that makes VCs valuable, because that's not something we can do or other people easily can do. Of course, there's a lot of money in that market, no question. But I think only, and that's what we know from VC over the last 35 years, and I think that will still hold true for the long-term future, is the teams who have good quality are able to select interesting and good projects. Those will be there for the long run, and those will be there who build fantastic, great, long companies, not the ones who just quickly push money everywhere.
What, do you agree, Aram?
Yeah, I mean, I would just add, we're at this point, we have now looked at over 150 dedicated venture blockchain funds. And similar to what Richard said, we're looking for teams that have been in the space for a long time now. They've built a track record by investing very early in these companies. So not once the tokens have launched, but at the private rounds, which are really competitive, where you can't get a big enough allocation. On the application network side, you're getting 5 to 10% max. On the equity infrastructure side, maybe you can get 15 to 20%. And these are teams that have the cryptographic distributed systems backgrounds. They have operating backgrounds in the space. And generally, I would say VCs at this point, when they are still investing in these rounds, it's similar to traditional venture. You have to help with mechanism design. You have to help with recruiting, go to market, product launch. And that can be a really competitive part of the market. It's much harder today to justify 2 and 20 if you're just investing in large cap exposure. There will be ETFs over time. As you mentioned, Thibauld, sort of the late stage of crypto is available to the public, because in year 3, year 4, these tokens are launching, and there is an opportunity for others to invest in those projects. Now, the early stage investors, to Richard's point, they take a lockup anywhere from 12 months to 36 plus months. They're aligned with their management teams. They take a discount in terms of the valuations. So they're not looking for actively traded pump and dump type strategies. They're investing over a 5 to 10 year horizon. And you need to help these companies with company building at the earliest stages. So we're looking for that kind of referencing for the right deal flow. And every manager is nuanced in their own way. Some are focused on a specific subsector like DeFi. Someone like Electric, has really technical chops. Someone like Fabric has great roots in the European geography. So everyone has their own strength in terms of deal flow reputation, and they can get in very early into those projects early on, and then hold these projects once they launch.
Okay.
There's one I'd like to build on that, Thibauld, if that's okay. Another area that has been fascinating to me. So I first, built a software company back in the 90s, and kind of shocked people in the market that we were focused on, which was telecoms, by using an open source version of Corba, a piece of middleware. And when it was it wasn't even deeply unfashionable. It was kind of unthinkable to use open source software. And then obviously, we've been through the different phases of MySQL and Linux and the Red Hat success and so forth, and trying to work out how to get open source a commercial model that works and thrives. And so along that path, there's been the experimentations with foundations, and now we have these massively valuable, not just open source software companies, but open source execution networks that have foundations within them and are trying to build communities and ecosystems. And we have in our partnership Anil Hansji, who has worked with Google on corporate venturing, and worked with PayPal on corporate venturing. He's got that perspective of trying to kind of serve multiple masters and sort of build an ecosystem and not just have the financial incentive purely and simply. And I think we've done a bunch of work with teams trying to get their head around how do you build the executive team, the board, the rules, the processes, the way you allocate capital to really create a thriving community. And I was just having lunch actually with someone from the Alan Turing Institute. They have a similar challenge, trying to do exactly that kind of thing. How to say no to projects, how to say yes, but but do it in a loosely coupled way and kind of let the whole community thrive and keep everybody engaged. I think if product management is hard, kind of that which is kind of ecosystem community management is kind of even harder. And I think that discipline is a really exciting speciality for investors in this space, to be at least proficient and helpful in, if not actually obviously be able to deliver or help build the team that can do that.
So let's dive into that. That's really interesting because obviously there's everything is being invented and reinvented right now. So usually when you were previously in the traditional world, you were creating a company, you had to decide on equity allocation, what the founders get, what investors get. And now where you're building this decentralized network, you need to decide of the early allocations of tokens, how big my network is, who gets what and everything. And so it's really an art right now. There's no rule, at least I didn't see any of them. And so this is why this network gets so valuable. That's a lot of team throwing to here saying, hey, we're building this decentralized protocol, and then they allocate themselves a humongous part of the tokens. And so I think it might be interesting to get your take on this and see if you had what do you think is best in class in terms of allocating these early tokens, the breakdown of it. And if you have any horror stories to share, anonymously, we don't want to shame anyone here, but it's interesting also for the audience to know. Maya, you want to take it?
Yeah, sure. I actually think it's fairly, it's fairly obvious to the market when there is something that's just very obviously a money grab, and people latch onto that and people realize that. I think that is one of the great things about blockchain is that there's full transparency. You can see exactly
Absolutely.
how much the team is allocating to themselves. And if the community rejects that, then, and you lose the community, you completely lose as a protocol, right? You really cannot afford to lose the community. And so I think some of the best launches, Gitcoin, of course, recently just launched their token. 50%, a little bit more than 50% is going to the community, 15% to retroactively to people who have engaged with them in the past, whether, in terms of funding grants or kind of initiating grants in the first place. Uniswap is another great example there where I think 60% of the tokens went towards the community. And so I think it's very obvious to people when a token is here to enrich the community and to actually do what it says it should do, right? Which is to coordinate the community and make sure that people in the community are adequately rewarded versus sort of a money grab from the team itself.
I think absolutely. I'll interject quickly and I'll then bounce something across to the LPs here. I think the transparency is, it's so powerful because at the end of the day, you're going to have some folks who try and pull the kind of a rug pull or try and just go after the money. But by and large, this is much greater transparency than we've seen in other forms of capitalism, frankly. And I think that can be very motivating for the community. But I think beyond the allocations, it should be the case that and maybe not all projects I've seen have gone far enough in this direction, that there should be these can be incredibly enriching projects for some of the founders, and that maybe they should be thinking about longer, vesting and lockup schedules than some have done hitherto. But the system's adapting. And I just wanted to also mention that something that's been kind of central to Fabric, and since our origins, kind of best part of a decade ago, I guess, originally, was to try and have our own community and collective. That the world of kind of ivory tower venture capital, where you kind of you just say, come to me and I'll have a chat with you and I'll decide whether or not this is a good idea and I've got all the answers, is long gone. Actually, I'm kind of sitting in an ivory tower a little bit here in the King's Cross campus, but I'm also sitting in the hot seat because there's no air conditioning and it's glass everywhere around me. But so aside from that, those days are gone. And then it's much more about a lot of interactions with your advisor community and your founder community on an ongoing basis. People are really at the coalface and know what's what. And I was just also having a conversation with a serial entrepreneur, someone who's incredibly successful in the open source space, looking at the opportunity to use tokenization to modify the venture capital model, not totally, so that you raise money through tokens and then short-term liquid and then try and invest it long-term. And that's where I thought the LPs might have some opinions, but to see if there can't be a pocket that can be used to kind of, more broadly reward the community built around yourself as a manager, more flexibly reward them, and therefore help venture as well evolve and adapt before it dies, like record labels and the rest of them. So I think that's pretty interesting. Maybe interesting to Thibauld as well.
Yeah. So, but one thing that I keep wondering when I hear you, like, okay, so these networks are open, so that means that now everybody is investing alongside you guys, right? So you guys investing, like LPs investing, VCs investing, is a strong signal sent to the market and say, hey, like there are professional people who believe this is good, right? And so and a lot of people tag along, probably a little bit later, a little bit at higher valuation, but they can and they do tag along. And so that creates, like, there's especially in the bull market right now, there's like newly minted, like millions of new crypto millionaires, right? And so those are people who can now reinvest. And I'm wondering, like, are we at peak VC performance right now? Like, because up until now, like, this didn't exist. So the early VCs who got into crypto first, like, enjoyed like incredible upside, right? And now that's going to be like this massive competition from all these new crypto millionaires. It has to affect the performances, right? Because the competition is heating up. And I think I'll go through every one of you, and we have 3 minutes left. So let's make it quick. Sorry, but maybe René, what do you think?
No, indeed, I think that's an interesting point. I think I mean, yes, there will be a lot of people that have generated a lot of returns and might actually want to consider to reinvest that money in other protocols and stuff they see. So I guess there might be on the midterm some what we probably call single GPs who might set up small investment vehicles either by their own money and act kind of as a business angel. And yes, there might be a bit of more competition coming, but from the VC side, I would say you need to see it from a way that how can you add value to these projects, and then as a business angel with one individual, yes, you could probably, and you can do so, but with a bigger team, you might have I would say a broader spectrum of tools that you can use, and yeah, so I'm not necessarily fearing that there is a lot of huge competition going that way. There might be more and more, but also in the let's say non-crypto world, there has been a lot of billionaires and millionaires, and either they've set up their own funds or done something with it, but there's never been a huge, I would say, inflow in terms of competition across the board. I think there's more opportunities than competition.
Aram, do you expect returns on VC allocations to go down in the future?
Yeah, I mean, just to answer the first part of your question, I think there is a big difference between managers who want to build a franchise and be the next benchmark Sequoia of crypto. I think you have two of those firms on the line today. And then there's a lot of smaller efforts in the space where there's an individual or two, they've done a couple of investments, they're now liquid, whether they've cashed in or not. I mean, they may not have the desire to build something institutional and long-term. Generally, I think what you have seen is a separation between traditional VC and crypto. Those two used to blend pretty well together over the past 5 years. Some of the traditional VC returns have been driven by crypto. If it was 5 to 10% of the funds, that's being more and more separated. You've had spin-outs from all the big firms, and the big firms have realized to do crypto well, you need specialized approach to it with a dedicated team. And so I do think there will be that separation. I mentioned there's now 150 dedicated firms in blockchain that are raising capital from institutional LPs. And you're going to see that delineation you saw in the traditional venture world, where the top 5 to 10% of the firms generate the majority of the returns. I think you'll see similar dispersion in crypto over the next decade. Unlike traditional venture, the outcomes in crypto will be larger and they may be quicker given the liquidity profile, but you will see a similar dispersion over time.
Okay. Sounds like we should continue to work hard to try and get into that top 5%, Maria. But I think I just wanted to say that from my So my sport of choice historically was rowing, and in that sport you sort of train yourself to keep your eyes in the boat and not get distracted. And thinking about performance as a focus is just like in a company thinking about a shareholder price is, I don't think, the right way to go. So we think just about the fundamentals of projects. And I think the other point I just make is that this is a very reflexive environment that, more capital just by and large means more projects and more talent, which means there's more opportunity. It's not like a zero-sum game there. And I think there's limitless problems to solve in the world and effectively and limitless talent out there to go and solve it. It's our job to just go and find, which of those projects are worth investing in.
Thank you very much, everyone. That was a wonderful panel. I hope the audience that you enjoyed it as well as I did. Thank you very much, gentlemen and Maya, and hope to talk to you soon.
Thank you all for such an interesting discussion. Oh, sorry, go ahead.
Oh, no, I was just saying thank you. Thanks for having us.
No worries. And for such an interesting discussion from those operating in this space with such a long vision, but also being at the cutting edge of the upcoming projects. I think the one line that really sums up these early stage projects to me is you can't afford to lose your community. And so up next, we have our panel, Post-Quantum World, What Will Be Crypto's Role Then? Moderated by Michael Hart at 3 p.m. BST. This is the Open Web Forum curated by Fabric Ventures. Be sure to check out our Twitter at Fabric_VC.